First up, though, Bernanke's signal to the market regarding the beginning of the tapering of QE may have signaled the end of a 30-year bond market. So where does this leave various classes of fixed income instruments, and how should investors be including them in their portfolios? That's just one of the questions that Paul Hanson will be answering for us this evening. He joins us in studio to discuss the options. And before we get there, Paul, let's start off with your sense of what exactly is unfolding on the developed market space. I mean, the US specifically, what do the markets want there? Do we want bad data, or do we want better data to come through? Because the markets at this stage seeming to be very schizophrenic.
They have been. You're right, Alicia. I think that, initially my interpretation or impression of what happened was that, his announcement in May and then confirmed in June that he would start tapering or cutting back his bond buying program or pumping cash into the economy, really caught the speculators short. The speculators, those who borrow in one currency and invest in another, and so on. The guys who are leveraged got caught short, and they scrambled for their exits, and that caused a lot of the volatility that was going on, and then caused others to bail out of their bonds and bond funds. So I think a lot of it was caused by more the speculative types, maybe hedge funds too, and because there's no question about it, we want stronger growth from the US. The world wants stronger growth. Everyone wants stronger growth. Equity investors want stronger growth. Maybe not so much bond investors.
Paul, are you the eternal optimist, the eternal bear? What's your take on the US recovery? I mean, the end of tapering, or the beginning of tapering of QE is a very positive sign for the underlying economy, because it means that the recovery's been gaining traction. So what's your sort of take on the US economic recovery?
Yeah, I think that they've done a fantastic job. I mean, we don't exactly know how it'll work when they get out of it, but they've done a fantastic job. They've been far more stimulatory towards their economy than any of the others. Now the Japanese are joining in, but the rest have been sitting on their haunches, certainly the Europeans. So hats off to the Americans. Their stock market closed last night 1% below its all-time record high. It had fallen about 7.5%, and that's because they've been far more proactive. So the economy is starting to follow through, the property's following through, the consumer's quite good. So it looks like perhaps in September the Fed may start to cut back its bond buying program, because the economy is getting stronger. And hey, well done, American, well done, Fed.
Yeah, what that's managed to do, certainly the US market and the Japanese market as well, is help the MSCI World Index increase, 10% in dollar terms so far this year, 33.5% in rand terms. But what it is doing at the same time is leaving emerging markets in the dust, or so it seems.
Absolutely, in the metal dust, in the mining dust. Yeah, because emerging markets, I think something like 30% of emerging market value or market capitalization is involved in the commodity space or the mining space. So they're heavily affected by the mining, the big bear market we've been seeing in mining shares. Certainly in dollar terms, they've been heading down at a rapid rate, maybe not so much, well, even in rand terms. So they, and also there's been the growth in the big BRIC countries has been disappointing. In each of those countries, it's been lowered and lowered and lowered again. And so the earnings have been disappointing in the emerging markets. So across the board, they've, it's been a disappointing time in the emerging market for equities.
Paul, but isn't this a big conundrum? Because everyone's been talking about the rate of Chinese growth slowing, and that's understandable given its size and the scale. So even at 7% over the last few years, the Chinese economy has been growing, while its biggest trading partner has essentially been going through a period of very subpar growth in the shape of the US. So isn't the American recovery a good news story for China as well?
It should be. It should be. It's just that China seems to have certain issues where they, for example, when their money market rate shot up the other day, it was engineered by the government to sort of wrap the banks over the knuckles about the shadow banking. There's too much shadow banking going on. So it'll be good for the whole world. But I mean, China's big growth has come from the capital spending in the last many years. It's still like 46% of the economy. And stories abound of excess construction, excess building of cities that are empty and so on. So they're trying to cut back on that. I think they're trying to get a more centered growth where they get the consumer more involved. So it's in a bit of a state of flux at the moment. I mean, you'd think 7% is a great growth rate. Any other country would love to have that. I don't think any other country outside of Africa has that, apart from China. But it's changing, and that's certainly hurting us commodity exporters.
So how's that influencing your investment strategy right now in terms of your exposure to developed markets relative to emerging?
Yeah, very heavily exposed to developed markets, very underweight emerging markets. Would actually almost prefer to be totally out of them at the moment. Although, interesting enough, we've seen quite a good inflow into the South African stock market. I think it's something like 8 or 9 billion rand net has come in from foreign investors in the last 10 days. And we're positive to the tune of something like 20 billion rand so far this year into our equity market. And yet, you know, which is strange, because I mean, there's been such an outflow out of emerging markets, and we are about 7% of the emerging market index. So interesting, they're coming into South Africa, despite.
Paul, obviously South African investors, many of them are thinking about the rand and the construction of their portfolios and how much they should have offshore. I remember a few years ago we were begging South Africans to take their rands offshore at R6.50 or R7 to the dollar. Now we've had this event post Marikana, and there's still this uncertainty which I think has been priced into the rand. Should investors, are you still thinking about taking more money offshore to hedge yourselves against the rand, or to invest in companies that are already hedged to any adverse movement in the currency?
Yeah, it's an interesting one, that, Warren, because one kind of gets the impression that maybe most of the fall in the rand, as you just intimated, has happened, and therefore maybe a good move would be bring some money back, you know, and rather invest in some of the sectors that have been hammered here, property, fixed interest, to a degree. But the trend remains intact. The trend that started, as you say, at 650 just over 2 years ago is still intact. So you have to respect the trend until otherwise broken. But at the same time, you sort of get the feeling that the rand may have seen its worst. And therefore, I'd rather come the other way, from offshore to here.
Offshore to here, but having said that, you've also said that you'd be taking a position totally out of emerging markets, and you're surprised at the kind of inflow we're seeing into South Africa right now. So if you had to come back, where exactly would you be putting that money?
Yeah, I say into some of the sectors that have been hammered. I think maybe over-hammered, like our bond market, our property market, and some of the equity market as well. Look, I think there's no question that standard we prefer the developed markets to the South African and emerging markets as far as the equities go. But at the same time, if you have had a pretty good exposure offshore, and certainly in the past, it's been quite a good idea to bring some back when the rand is blown out. We saw that in 2001, we saw it in 2008-9. If you brought money back at 10 or 11 in 2008-9, you were very happy when it went to 650. Now, I'm not saying we're going to 650 or even 750, but it's a strategy that's worked quite well in the last 12 years.
Mm-hmm. Paul, we've got also wanted to pick your brain regarding the different investment styles and managers that you use for some of the portfolios where you use third-party investment managers. Obviously, there's a debate between value and growth, and which particular styles have been outperforming lately, but which might outperform in the future. I just wanted to get your views on whether you had changed any of the balance of the portfolios you run to favor a particular style of investing in particular.
No, not really. As far as style goes, I use fund-to-funds approach. So in the funds that I manage, international, balanced, conservative, aggressive, I'm mostly using Fidelity Investments at the moment, their funds, and I'd rather pick the fund itself rather than the actual style. In other words, what region it's in. We're favouring the US, we're favouring Japan at the moment as far as equities go, and we're favouring the US dollar as far as currencies go. So it's more fund related than actual style related.
Yeah. Let's shift focus very quickly to the fixed income side of things and how you're viewing things in that space, because higher bond yields, you've highlighted in your note, a mild negative right now, but you've also got to look at things very relatively, the fact that we are coming off a very low base. So to what extent are you taking cognizance of those rising bond yields? And it would imply, especially with your short-term interest rates looking to stay lower for longer, that this is not entirely a game changer moving forward.
Well, it may not be exactly. Some people think that's the end of the 31-year-old bull market in bonds, and it may be. But when you look at the fact that global growth is low and has been low, forecasts have been lowered yesterday by the IMF right across the board, including in South Africa, dramatically in South Africa, and you look at inflation extremely low in the developed markets, then it doesn't look like it's such a bad environment for bonds at the moment, I must admit. So maybe the sell-off's been overdone. Maybe there's an opportunity, and certainly for pension funds that rely a lot on the certainty of bond yields offshore, it's quite attractive that yields have gone up 1.5%, because that gives them an opportunity to lock in higher yields, big pension funds. So I'm not convinced that it's all over for bonds.
Paul, I just wanted to also get your perspective. Obviously, this has almost been an unprecedented period of the world's economic history, with the amount of quantitative easing that's been used to try and revive the world economy. Do you think there are any risks in the world economy at this point from the unintended consequences of quantitative easing?
Sure. No, we've never been through this in our history before, as far as I know. So there's a lot of uncertainty or risk, as you say, with regard to how it's going to unfold as we, as the US starts to taper and cut back and eventually get out of it completely, and what's going to happen with Japan, how long they're going to keep on doing it for. Are they going to get out of deflation into inflation? And will there be inflation down the road for these countries because they've pumped so much money into the economy, or will they be able to manage it? So there's lots of unknowns there. So the question was, either you go into a Great Depression if you didn't do this, or you take the risks that we just talked about and go the QE route and pump big money into your economy. And so the Fed has taken that route instead of going into the Great Depression and having 10, 15, 20% unemployment.